Welcome to the FinLink Fincast, where we talk about everything wealth management, especially as it pertains to M&A. Here is your host, Xander Heinen.
Welcome to the FinLink Fincast. Today we have a very special episode. We're here in Wilmington, North Carolina at the headquarters of Live Oak Bank. Today I'm with Mike McGinley, head of small business banking for Live Oak, and Wayne Hewett, the business development officer for the loan team which handles the investment advisory vertical. Thanks for being on today, guys.
Thanks for having us, Ron.
Awesome. So today we really wanted to get into one of the new products that Live Oak is offering, which is the Live Oak Express program. This is a great product for smaller loans, both SBA and conventional, correct?
Yep.
And it's a much quicker type of financing that can really help advisors and CPAs as well as insurance advisors on the FinLink platform. So I'd love for you, Mike, to just give a little brief update on what's going on at the bank, and especially as it pertains to the Live Oak Express program.
Yeah, I'd love to. So I'll take a step back for a second and talk a little bit about a couple of the trends going on in small business banking that really lead to this product being an important part of what we introduce to all of our small business customers. With technology, increasing at a rapid pace, and a lot of AI technology being implemented into loan origination softwares and out in the market, you've got small business owners with more options than ever in terms of access to capital. And that also means that there's forms of capital that may not be the best option for a small business, even though they can get the money really quickly.
Right.
And so, an example of that is a merchant cash advance. You can get money in your hands very quickly. It's good for certain types of capital needs, but it's misused a lot because they're really aggressive repayment terms, and if you don't use that as a short-term bridge to other capital, it can really be a detrimental blow to the small business. And really, they're kind of accessing that capital when they have a cash flow crunch. So we set out on a mission to provide quick capital the right way from a bank and do that with an expedited loan process. And we started with the verticals that we lend to at Live Oak Bank, and we've since expanded that out to all small businesses. And the mission is really to continue to iterate and get capital out to small business customers as quickly as possible. So think really slick applicant portal and application, expedited underwriting process. You start to build capabilities through APIs to connect to data sources so that you can take data in on behalf of a customer as opposed to asking them for that documentation. And that's only going to get stronger and stronger. And so those loans are under $500,000. The SBA 7A product has a small loan offering that is $350,000 and under. But we have ways of doing it either conventionally or with a different SBA product up to $500,000. So that's on a 10-year term, so you still have a long repayment ability. It's a marketable bank rate, and you get that capital a lot quicker than a typical bank loan where you're doing a full underwriting and collecting everything that you need for a closing.
Yeah, not only is that time consuming to get those documents over, but it can take a long time to close the actual loan. So what's the typical start to finish time?
A couple weeks.
Couple weeks?
Yeah, and that will continue to go down further and further. It also depends on what loan product it is, what type of loan. So if it's a business acquisition, then you're still collecting purchase agreements and things of that nature versus a working capital loan where you're really just collecting the documentation needed to underwrite the transaction and then onboard the small business as a customer versus getting seller financials and everything else. So it's really dependent upon that type of transaction. But it's great for advisors, especially looking to recruit someone and maybe get a quick loan, working capital to buffer quarterly revenue pulls, those types of things.
Right. Now, Wayne, are you having those conversations a lot, and what do they look like? I know when you know, in my former days as a banker, a working capital loan was usually for lumpy payments for payroll or whatever. Is that the conversations you're seeing?
We're seeing it all over the place. One of the things that I'm really enjoy about it is working with the individual advisors. I'll share a couple examples. Last week, I was speaking with an advisor. She's investing in her business, so she's looking at this as an option to go ahead and bring on staff, probably a little bit sooner than she normally would have by revenues, but she's investing in the business, so she's using it for that. The other thing that I'm seeing quite a bit of activity and interest in is a lot of advisors, particularly if they're affiliated with an independent broker-dealer. Broker-dealers kind of go through cycles where they're lending, they're not lending. We're starting to see some put like a minimum that they'll lend in. So this Express product's fitting a great need for kind of that smaller loan, say under the 350, and that's where I'm having the most conversations right now with advisors buying out what you would call a traditional A-share book. That's where we're seeing, investing in the business, bringing in some talent, or buying some of those smaller traditional A-share books.
So it can supplement a broker-dealer loan as well.
Absolutely.
Yeah, that's interesting. What are you seeing in the IA space today, as far as, outside of the SBA or the Live Oak Express product? What are you really seeing with the larger products that you are speaking to?
Where I'm having the most interaction, the most conversations, really around two products. One, it's really around kind of the equity buy-in. It's kind of unintended consequences, but a lot of firms are the victim of their own success. They've either grown to a point or they are growing at such a large compound average growth rate that for the G2 or the next generation advisor to be able to be the ultimate successor, they're looking at that internal equity purchase option right now. So we're having a lot of conversations around there. And then also the other thing I'm really looking at is for some of our larger firms, our delayed draw term loan with firms that have more than 2 million of EBITDA, being able to set up that credit facility for them as they continue to grow through strategic acquisitions. Those are the two conversations I'm having the most right now.
Yeah, and that's like an acquisition line of financing, right?
Correct.
Yeah. And the partial equity buy-in for next-gen advisors, we hear a lot of different names for that product. So next-gen loan,
absolutely,
partial equity buy-in.
I was speaking at an event yesterday in Dallas, and that was the part that I was really kind of the point I was trying to get across is, time, as with advisors, I was joking, is it easier to help a client plan for retirement at 42 or 62? And so they're 42, and I'm like, well, then why are we doing this with our business? And so really getting the G2s that were there loved the session. They were like, they had never even thought about it.
Yep.
And so it's just the thing that we stress is start having the conversation. This isn't a can we want to keep kicking down the road.
Mike, you were in the investment advisory vertical way back in the beginning. You're
Early days,
kind of a pioneer in this space. Multiples back then, when you started in 2015, were not anywhere close to what they are now.
2x revenue, 3 maybe 4x EBITDA at the time.
Yep. So now we're seeing almost 4x revenue.
Yeah.
This makes it a lot harder for the G2 next gen guy to buy in. How are you guys seeing that? Is that a big problem? If someone can't afford the debt repayment from the salary they're making, how do you guys, what's the fix for them to come in and be able to get their debt service?
I can start. You can clean me up.
Yeah, go for it.
A lot of times we'll see partial equity deals where the employees of the business or even some smaller owners are buying it over time. So sometimes it's just too big of a chunk to bite. And so we've got a partial equity program. We can talk about that. There's other structures we see a little bit, ghost equity, things of that nature. But the most common thing we see are partial buy-ins.
Yeah. And yesterday, or I guess prior to yesterday's event that I was at, I was actually meeting with a couple of former clients from my previous role that now we are looking at financing those equity buy-ins. The key thing is just starting it earlier, like stressing with that G2, making sure, they're a qualified buyer. As we've always said when we present with the Succession Resource Group, have their financial house in order. So the conversations went really well. If time is on our side, then we can build into it. Now, also the other thing that this conversation is really kind of helping from a business owner standpoint for the advisor is it's, having the conversation with the team members. Do you want to buy in versus do they truly want to be an equity owner, or are they just looking for more compensation? So this has been a great conversation for the business owner or the advisor to really, is this someone who wants to buy in, or is this someone, maybe we'll look at some restricted stock units, kind of something more reward long term. But it's the key thing I just love to stress is let's start having a conversation sooner rather than later.
Yeah, I think I say this on every one of our podcasts, but we did a survey within the FinLink community. We have around 80,000 members. 13,000 of our members do not have a succession plan. So let that be kind of a warning, I guess. Start early and know what you want. Get your financial house in order. That's a best practice that we're all seeing. One thing I did want to kind of clear up, I think there's a big misnomer in the community still that Live Oak Bank only does SBA loans. I want to just emphasize that, you guys have definitely changed over the years. So would love to hear, what it looked like when you started and what you're seeing now.
Yeah, it's interesting. That is the number one thing that I hear. Well, you guys only do SBA. I'm like, no. And we'll share some data with them for 2024. 85% of the loans we did were conventional versus 15% as far as SBA. I think this year we're trending somewhere between 80 to 85 again on the conventional. The great thing about it is, as I share with the advisors, we're going to do what's in your best interest, fiduciary, if you will. If SBA is the best route, that's what we're going to go. If we're able to do conventional, we're going to go that option. But yeah, when you brought that up, I kind of had to smile a little bit because that's, I would say, is quite a bit of what I'm doing in my current role is like, no, we do more than SBA. And a lot of folks, like when they see that deferred draw term loan, the equity buy, and they're like, wow, we had no idea. So it's just getting the message out there.
Yeah. Now, Mike, I kind of want to lean on you. The founder of the bank, Chip Mahan, always has some great terms of endearment, and he really likes to speak to the culture of the bank. I would love, for you just to explain who Live Oak is to someone who just sees this on a computer screen or an ad. I don't think you can, really show what this bank is in terms of how special it is when you go through a medium like that. So just give us a little history on the bank and why it's such a special place.
Yeah, so the bank was founded in 2008, and Chip has always been a serial entrepreneur thinking about going to where other banks aren't going, and how do you help out communities that need capital. And so we really flipped the model on its head. Instead of setting up branches and collecting deposits in a geography and lending against those deposits, we decided to pick industries that we felt were strong from a credit perspective, were scalable, and lend online, right? So we have other bank products. We have checking, savings accounts, CDs, but really the forefront of what we were doing were lending to those industries and providing capital where we felt there was a gap. And so, we started off with vertical lending only. The investment advisory group was our fifth vertical, and we've since expanded to all small businesses, and we've got lenders in different geographies handling all types of loans. And then we've got our vertical teams who focus on an industry.
And how many verticals are there?
About 35.
That goes from that's a great kind of thing for our audience to know, because you can provide financing to a host of different small businesses, to RIA clients and insurance agent clients, et cetera. I guess the biggest verticals, the top 5 would be veterinary.
Healthcare, our senior care right now, given the macro demographics and baby boomers retiring, our senior care vertical is doing great. We also have a commercial team, so we've got a senior housing sponsor group, a utility grade solar farm lending team, and then IA, CPA, insurance, professional services are big too.
Awesome. Well, are there any last words you want to leave off with here, Wayne? Now that you're the business development officer on the IA team, I'll leave it to you. He recently came in and is filling some large shoes of our friend John. But I just wanted to leave it to you for the last couple words here. And
Well, as the audience will quickly learn, I am not shy. I'm not afraid to talk. And it is hard, the old adage, a tiger can't change its stripes. When it comes to succession, I have to share the funny story. I'm here because John Turner, I've worked with him for years on my succession deals, and we've joked I was his succession plan. So when he decided, it was a natural conversation. But no, and one thing I want to share for the advisors that are joining us today, here's just a useful little arrow for the quiver. I'll tie it back to the express loan. Where I've, over the last 2 years, seen a lot of activity is you've got some advisors that have built their business through A shares. And there's nothing inherently wrong with that. At the time, it was the right product, and they're ready to exit. So, what you're seeing out there in the competitive landscape is a lot of advisors, they only want to do it on an earn-out,
right.
purchase it. So, you have $40 million of A shares. You're able to come in, get finance using the Express product. You can offer more more fixed dollars. That's going to be very attractive as compared to doing it just on an earn out. So that's an option. Look, if you've got those folks in your network, have a conversation. Give us a call here at Live Oak. We'd love to dive into the Express loan a little bit more. But if you're able to bring kind of more of a fixed payment with a little bit of a look back versus all earn out, which, let me put my compliance hat on, seek your CPA for tax guidance, but generally earnouts are taxed at ordinary income versus long-term cap gains. That's going to give you a little bit of a competitive advantage in negotiations, and if we can be of help, please give me a call.
Yeah, so all of our listeners can reach Wayne via our resource page. There's a lead button where he will get back to you. Guys, I really wanted to thank you today for this. It's nice being back at the Live Oak campus, and it was really great speaking with you.
Thank you.
Thank you.
Appreciate it.